week we started chapter 6. All right, chapter 6 is on merchandising businesses. The main difference between a merchandising business and a service business is the way that they calculate profit. So with a service business, remember we had fees earned, and then we had all of our expenses. And when we figured that out, we got to operating income. In a merchandising business, we have an extra step. And the reason that we have this extra step is that the things that we are selling, we previously bought. So we have to take that cost into account whenever we're deciding or whenever we're trying to calculate the amount of money that we made. So instead of fees earned, we record it as sales because we're making a sale. Okay, so sales is our revenue. And then for each sale that we make, like we just said, there is a cost associated with that. And that is called cost of merchandise sold. So for each sale that we have, there's a cost associated to that individual sale. Sales minus cost of merchandise sold gives us what? Anybody? Yeah, gross profit. So we can figure out the gross profit on a particular item by taking total sales of that item and then the total cost associated with it. So sales minus cost of merchandise sold gives us gross profit. Then we take those same operating expenses, like salaries, electricity, all those things, and we come to operating income. All right. So there's a little bit of difference. In a merchandising business, we added some new accounts. Cost of merchandise sold was one. Merchandise inventory is one. So merchandise inventory is the inventory that we have left over at month end. Cost of merchandise sold is an expense. And it's an expense that goes up against our revenue items to show us gross profit. Okay, now what we did not get to last Tuesday is freight. All right, so we looked at a few examples of a sale. So a customer made a sale, or a customer came in and purchased some items, and every time that we make a sale, remember, we have to make 2 journal entries. So we first record the sale. So there's 2 different ways you can make a sale. Either cash or on account. So if we make a cash sale, we receive cash, we record the revenue. That's the first journal entry. Now, also, we have to account for the cost of that sale, the cost of that item, and then we also have to remove that piece of inventory from our books. So every time that we make a sale, we have to make 2 journal entries. So then we would debit cost of merchandise sold, and we would credit merchandise inventory. So in a cash transaction, that's the end of it. That's done. Customer comes in, they pay cash, we're done. The other way that you can buy it is on account. Now, we talked about this a lot last week. When we make a sale on account, we are giving the customer some leeway time to pay their invoice. And as an incentive for them to pay it sooner, we could offer them a discount. Okay, you guys remember talking about that? And a discount could be 2%. That's normally what they're going to have in our book. You're not going to see much greater than that. So these are called credit terms. You do not have credit terms in a cash sale because once the sale is done, it's completed. Okay? So these credit terms say you can have a 2% discount if you pay your bill within 10 days. If you choose not to pay within 10 days, the net amount or the whole amount is due within 30 days. All right? So on an account sale or on a credit sale, we're going to debit accounts receivable and we're going to credit sales. And then same thing here. We have to account for the cost of the merchandise that we sold, and then we have to get that inventory off of our books. The only difference when we make a sale on credit is that then that customer has to come back and pay off their balance. Okay, so there would be a third piece to that sale. So that customer would come in, they would pay us in cash, and then we would get rid of their account receivable or their promise to pay. This part we've seen before when we had credit, when we earned revenue on credit. Okay, so that's kind of what we talked about last week. Associated with purchases and or sales, something that's called freight. And freight is shipping cost, partly shipping cost. Okay? So the book says purchases and sales of merchandise often involve freight. And the terms of that sale indicate when ownership, which is title and control, of the merchandise passed from the seller to the buyer. Okay, now that also determines who pays for shipping. So there's two different methods that we consider freight. And it's FOB shipping point or FOB destination. And FOB stands for freight on board. Okay? And the name of that, or the name of the method tells you when ownership passes hands, or when it switches from the seller to the buyer. Okay? So the ownership of the merchandise may pass to the buyer when the seller delivers the merchandise to the freight carrier. And you know the freight carrier would be FedEx, UPS, United States Postal Service. In this case, the terms are said to be FOB shipping point. All right, so in FOB shipping point, or free on board shipping point, ownership or title of all that merchandise changes hands when it reaches the shipping point. Okay? So take, for example, if we buy something from Best Buy. Okay, let's say that we buy a computer from Best Buy. And the terms of our purchase are FOB shipping point. Whenever let's say it ships from California. Whenever they drop it off at the FedEx store in California, it's our responsibility. If something happens to it along the way, the ownership has changed hands, so it's ours. Okay, so if it gets lost, if it gets damaged, we are in control of it from the point that they drop it off at the mail or the freight carrier. So once they drop it off at FedEx, Best Buy is out of the equation. Okay? So this term means, so if it's ours as it's being shipped and as it's being carried across to Mississippi, then we should be paying the freight cost, right? Because it's our responsibility. Hey, David, can you put your mask on? So this term means that the buyer pays the freight cost from the shipping point to the final destination. Okay? Such costs are part of the buyer's total cost of purchasing inventory and are added to the cost of the inventory by debiting merchandise inventory. So what that means is, if we buy a computer for $1,000 and then they charge us $50 to ship it, what is the total cost of that computer to come to us? It's $1,050, right? So we would record that piece of inventory as $1,050. And we're going to learn this in a lot more detail in chapter 10. But when you're talking about assets, you can include every cost associated with getting that asset set up and running as the cost of that actual asset. So when you buy a car, if they charge you $1,000 to ship it, you can include that $1,000 in your initial cost of the vehicle on your books. If you buy a machine and that machine has to be shipped, you have to have a special technician come and set it up. All of those costs can be included together as the overall cost of that machine. The same thing here. So the term means that the buyer pays the freight cost, and then those costs can be added to your total merchandise inventory cost. So let's look at this example right here. And this is all for FOB Shipping Point. So we own it from the time that they take it to FedEx until it reaches us here in Mississippi. All right, so on June 10th, we purchased merchandise from this company for $900. The terms were FOB Shipping Point. Also on June 10th, we paid freight of $50 for this purchase. Okay? So they make it into two separate transactions so that we can easily see the distinction. So the first transaction is the purchase of the merchandise. So in that first transaction, we purchased merchandise from Magnadata for $900. Did we receive anything in that transaction? Yeah, we received merchandise inventory. So we would debit merchandise inventory for $900. Now, how did we pay for this merchandise? We paid for it on account. So we would then set up a liability as accounts payable, and that's a promise from us to pay this Magnadata company at a future date. So we would credit accounts payable. All right, so that signifies our purchase for the actual goods. Now we have to figure out how are we going to journalize the freight. Now we're receiving these items, we are paying shipping on these items, and from the minute that they take it to the distributor, it's our ownership. We receive ownership from the minute that it is shipped. So because of that, we can include that shipping cost as an additional cost to merchandise inventory. So same day, we would debit merchandise inventory for $50, and then we pay the freight in cash. Okay. All right. So what's the total cost of the inventory in this transaction? $950, right? The $900 for the actual inventory, and then the $50 that it takes to bring it to us. Okay? So that's FOB Shipping Point. If you are the owner of the goods as they're being shipped, you would pay for the freight or for the shipping charges, and we can include that in our overall cost of our inventory. All right, so let's look at the other side. So the other side is FOB destination. The seller bears the freight cost if the shipping terms are FOB destination. So in FOB destination, ownership does not transfer from the seller to the buyer until it reaches the final destination. So our same example about the computer, if we buy it with shipping terms FOB destination from Best Buy in California, we would not become the owner or have any responsibilities for that computer until it reached our house or school here at Blue Mountain. Okay? So the ownership of the merchandise may pass to the buyer when the buyer receives the merchandise. So once it's reached its final destination. In this case, the terms are said to be FOB destination. This term means that the seller pays the freight cost from the shipping point to the buyer's final destination. When the seller pays the delivery charges, the seller debits delivery expense or freight out. Delivery expense is reported on the seller's income statement as a selling expense. So that makes sense. So if you're the seller, you sell something to someone and you ship it FOB destination, that means that it's your responsibility the whole way from your warehouse to their house, place of business, whatever. In that case, when you, the seller, pay for shipping, it's delivery expense. It's an expense to you that you have to pay in order to perform your business. Okay? So let's look at this example. All right. So on June 15th, it says that we sold merchandise. Oops, went too far. On June 15th, we sold merchandise to Kranz Company on account for $700. The terms were FOB destination. The cost of the merchandise is $480. Net Solutions pays freight of $40 on the sale of June 15th. You will very likely see a question very similar to this on the test. Okay, so that's all that it's going to say, but there's a lot to unpack from those three sentences. Okay? So what's the first thing that we should do? Are we the buyer or the seller? The seller. All right, we know that because it says Net Solutions sells merchandise. We also know it because the first sentence says that we sold merchandise. All right, so anytime that we're the seller, that should trigger in your brain that we're going to need two journal entries to account for that sale. The first to record the sale, the second to record the expense that was associated with the sale. Okay? Was this a cash transaction or was it a sale on account? How do we know? Yeah, it says it right there in the first sentence. So we got to be sure, you have to be sure and read the entire question so that you know what's being asked. All right, so on June 15th, we sell merchandise to this company on account for $700. So we're going to debit accounts receivable. Number one, because they didn't pay cash. What type of account is accounts receivable? It's an asset, right? It's a promise from our customer to pay at a future date and time. All right, so we're going to debit accounts receivable for $700, and we're going to credit sales. So this right here, that accounts for the actual sale. Now, as the seller, we also have to account for the reduction in merchandise inventory and the cost that were associated with that sale. So our second journal entry would be a debit to cost of merchandise sold and a credit to merchandise inventory. All right, so that's the way these two entries will always stay the same. The only thing that will change will be the dollar value. Okay, now they gave us what the cost of merchandise sold is, and it's $480. So we debit cost of merchandise sold for $480, and we credit merchandise inventory for $480. All right. Now lastly, we have to look at the shipping terms. Okay, now it says it was shipped FOB destination. So an FOB destination, that means ownership does not change hands until it reaches its final place, until it reaches the business of this company that purchased it. So in that case, we, the seller, assume ownership as it travels. So if it gets broken, if it gets damaged, lost, etc., it's our responsibility. So if we own it while it's being shipped, we should be the ones to pay the shipping charges. Okay? And it says the shipping charges are $40. So say that you don't know about the journal entry. And you're on the test. You're taking the test. You have no clue what to debit or what to credit. You could at least get partial credit by putting the amount there. Okay, so we know we're going to debit 40 and credit 40. Now we just have to figure out how are we going to journalize it. What's going to be the account we debit? What's going to be the account we credit? Now, if we, the seller, are paying for this shipping cost, we know that it's going to be an expense for us. All right, now I know we just read that it's delivery expense, but act like that or try and forget that we just read it. So if we know that we're paying for this shipping cost, we know it's going to be an expense, and it's a delivery expense. That makes sense. So an expense, the way that we increase expense is by making a debit entry. So we would debit delivery expense, and freight is always paid in cash. Okay? Okay? Now, can the terms be FOB shipping point and the seller pay for shipping? Any of you guys have Amazon Prime? All right. So do you pay for shipping on most items with Amazon Prime? Not directly. We probably pay for it indirectly with higher prices, but it's free shipping. All right. So this next paragraph talks about that. So the seller may pay the freight even though the terms are FOB shipping point. So FOB shipping point ownership transfers from the moment they take it to the post office or the moment that they take it to UPS or FedEx. From the moment it ships, ownership transfers to the buyer. So the seller could prepay the freight even though the terms are FOB shipping point. In that case, the seller would then add freight to the invoice. And we would see it as a line item on the invoice. So in that case, the buyer would debit merchandise inventory for the total amount of the invoice, including freight, but any discount terms would not apply to the prepaid freight. All right, so that says, let me show you. So basically saying, if we bought goods for $1,000, okay, freight was $50. And they offered us a 2% discount. We could take the 2% from the inventory, but we couldn't take 2% of the freight. Okay, so you don't get a discount on freight. The cost is what it is. So that's what that last sentence is saying. Okay, so let's look at this example. All right, so this is an example of terms FOB shipping point, but the seller pays for freight. All right, so let's look at it. So it says on June 20th, we sold merchandise to this company, to Planner Company, on account for $800. Terms are FOB shipping point. So who assumes ownership while this is being transported? The buyer or the seller?
The
50-50 shot.
buyer.
Yeah, the buyer assumes ownership while it's in transit because ownership transferred at the shipping point. Okay? So you'll more than likely see a couple questions about that. Who assumes ownership when this shipping term is associated with it? Who assumes ownership when the FOB destination is associated with it? All right, so we sold merchandise to Planner Company on account for $800. Terms FOB shipping point. Net Solutions, which is us, the seller, paid freight of $45, which was added to the invoice. The cost of the merchandise sold is $360. All right? So Net Solutions records the sale, the cost of the sale, and the freight as follows. So we made a sale for $800 on account. So debit accounts receivable, credit sales for the $800, the actual amount of the sale. Then we have to record the cost of the merchandise that we sold and credit that merchandise inventory because we no longer own it. So debit cost of merchandise sold, credit merchandise inventory for that cost of $360. And then the customer is paying for the freight. They're paying us back. So that's going to be included in their overall amount that they owe us. Okay? So the total amount that they're going to pay us is $845. But who paid for the freight? We did, the seller. And freight is always paid in cash. So we would credit cash of $45 because we paid for the shipping, but then the customer is going to reimburse us. So the customer's total bill is $845. Does that make sense? You guys see the difference there? So that's a little bit different than the one we just looked at. All right, so here's a good chart. So FOB shipping point. Title passes to the buyer as it leaves the buyer or the seller's warehouse. The buyer assumes ownership. The buyer pays for freight. And if the buyer pays for freight and they are owning this good as it's being transported, that cost is added to merchandise inventory. All right? Under FOB destination, ownership doesn't pass to the buyer until it reaches the destination. So the buyer does not have any ownership while it's being shipped. They have no worries about it. So they cannot add that cost as merchandise inventory. The seller pays for freight. Okay? So you have to be able to distinguish the difference. And I know this is probably the first time you guys have heard this. So if you leave here and don't look at it again until the test, there's a good chance you'll get confused. You need to go back through and read it over again. It makes sense when you think about it. So it's all about the terms tell us when ownership passes. Okay? And if you own it, you're paying for it. So that should alleviate any of the confusion. All right, let's look at this problem right here, and then we'll look at some homework. All right, so determine the amount to be paid in full settlement of each of the two invoices, and assuming that credit for refunds and allowances was received prior to payment and that all invoices were paid within the discount period. So let's look at this for a minute. All right, so part A, they're two separate parts. Part A, merchandise was purchased for $4,500. Freight was paid by the seller. The terms were FOB shipping point, and they offered a discount of 1% if it was paid within 10 days. If you chose not to act on that, the net amount was due in 30 days, and then they returned $800 worth. So a whole lot going on here. So let's break it down, okay? So we purchased $4,500 worth of goods. And then they returned $800 worth. Okay? What was the discount that we were offered? 1%. And as we said last week, we always assume that the customer takes the discount. And even if we didn't, the problem says all invoices were paid within the discount period. Okay? So we know that 1% of 4,500 is $45, and then $8. Okay? So they purchased $4,455, and they returned $792. So their total purchase was what? $3,663. So this is before we ever look at freight, okay? So are you guys with me so far? Do what now? Oh, I messed that up. 3863. All right. Or wait, no. We're jumping ahead. 4455 minus 792 is 3663. Okay. So that's the amount of merchandise that we purchased. All right.
Subtract 800 from the 4,500 first, and then just take 1% from that. Does he get the same answer?
Yeah, I agree with you. I think they want you to do it in two different steps, though. Just because Part B here, assuming that credit for refunds and allowances was received prior to payment. So say that we purchased it all, we took the discount, and then sent it back after the payment was processed, then it would be two separate transactions. So I think they want us just to get in the habit of doing it separately. But you're right, you could do it all at once. All right, so bought 4,500, sent 800 back. We received a 1% discount, so we applied the 1% discount. So the merchandise that we purchased was $3,663. All right, now we have to figure out about freight. Who paid for the freight? The seller did. Okay, so that's $200 for freight. Now, when did ownership transfer from the seller to the buyer? If it's FOB shipping point.
When they dropped it off.
Yeah, so when it was shipped. Okay? So if the buyer maintained control as it was being shipped, then the buyer should pay for that shipping. And if the buyer is paying for the shipping, they can add that to the total cost of merchandise inventory. So the total cost that it took for them to gain those goods to be able to sell in their store. So the total amount that would be charged to merchandise inventory would be $38.63. Okay? Now, so that's the $38.63 is the right answer. Everybody understand that? David, you good? All right. So let's look at B. All right, so in B, we purchased 5,000 worth of inventory, okay? And then they sent back 2,500. In this case, it was a 2% discount. So the total discount would be $100. And then $50, right? Yeah. All right. So that would be $4,900, and then $2,450. So $2,450 is the amount of merchandise that they purchased. Now, what are the freight terms in Part B? It's FOB destination. So the buyer of those goods did not have any ownership while it was being shipped. So they can't assume ownership of the freight charges. Even if they pay for them, they can't add it to the total of merchandise inventory that they record on their books. So in Part B, the only amount for merchandise inventory is the cost that they paid for the goods. So does that make sense? Under FOB shipping point, when the buyer is paying and is assuming ownership of the goods while they're being shipped, that freight can be added to the cost of the merchandise. Under FOB destination, when they don't assume ownership until it is delivered, they can't add that freight cost to the overall cost of their merchandise. So it's a big distinction. What's up?
So as the seller, whenever you charge on account, we have to enter it in assuming that they're going to take the discount.
Right.
But as soon as the time has passed for the discount, would we just go back in and add that?
The difference? Add the discount? Yes. But in our scenario, we're always going to assume they take it.
Right.
But yeah, if you were a seller and say that you go ahead and figure out that, hey, we assume they're going to take the discount. On day 11, you would go in and add that additional discount back as an account receivable and then add it back to your inventory.
Now, those terms would be on the customer's invoice, so we wouldn't have to send them an additional.
No, yeah, they would already have all the terms. And you would make it clear to them. So on the day they bought it, you'd say, hey, if you pay within 10 days, I'm going to give you this discount. If you choose not to, then you're going to owe me the full amount. So yeah, it's a good question. Anybody else? Okay. Let's move forward. All right. So this is a little bit of a recap. So under merchandise inventory. So reporting merchandise inventory transactions under the perpetual system. Remember, perpetual system means every purchase and every sale is recorded in our inventory. The periodic system, we would record all purchases, but the sales, the removal of inventory would not be recorded until the end of the month when we would actually go in and do an inventory count. Okay, now for our purposes, we said we're going to use the perpetual system. So all purchases and returns are going to be, or all purchases and sales are going to be recorded. Okay? So, for merchandise inventory, what would increase the balance of merchandise inventory? We made a purchase. So first of all, what type of account is merchandise inventory? It's an asset, right? We use it in our business, so it's something that we own. So merchandise inventory is an asset. So what would increase that asset? Purchases. And then we said we're always going to take the discount, so it's net of the discount. So any purchases that we make, that's going to increase our merchandise inventory. What else would increase it? Freight for merchandise that we purchased, as long as the shipping terms were FOB shipping point. If it's FOB destination, we don't assume any ownership while it's being shipped, so we can't claim that cost was associated with bringing that merchandise into our warehouse or into our store. So only FOB shipping point can be added to the merchandise inventory cost. Okay? So this is a T account that we're looking at. So these are things that increase merchandise inventory. What are things that decrease merchandise inventory? Obviously, when we make a sale, when we make a sale, we're getting rid of inventory in our warehouse. So that's going to decrease it. Another thing that would decrease merchandise inventory is if we had a return. Now, I'm going to do my best not to have any returns on the test, just because it gets a 2-sentence problem, could have a lot of details in it. But it makes sense. If you make a return, then you're decreasing your merchandise inventory. Okay. Then cost of merchandise sold. Who remembers what type of account that is? Starts with an E, ends with expense. So cost of merchandise sold is an expense. And if it's an expense, the way that we increase that expense is with a debit entry. So anytime that we sell goods, or anytime that we sell merchandise, we have to record the cost of that merchandise that we sold. Any questions? All right. So this is a lot on this chart, but we're going to walk through it. Okay? So this says each merchandising transaction affects a buyer and a seller. So in theory, on the test, I could give you a transaction, and I could ask you to journalize the buyer side and the seller side. And you should be able to go through and determine how would the buyer handle this transaction, how would the seller handle this transaction. And that's exactly what this is doing right here. Okay, we're going to walk through a problem like that. But this Exhibit 10, I would say, please go back and review this, because it's going to tell you from the sale to the freight to the payment, all of those things, it's going to show you what the seller records and what the buyer records. So let's walk through one ourselves, okay? If you scroll down to the bottom, example 6.5. So let's take a minute and look at this, and then we'll walk through it. Okay. So this company sold merchandise to Bray Company on account for $11,500. Terms, a 2% discount if paid within 15 days. If that's not acted on, the net amount is due in 30. Cost of the merchandise sold is $6,900. Journalize the entries for both the seller and the buyer for the sale, purchase, and payment of amount due. All right, if I gave you a problem like this on a test, it would be like this. I would avoid freight, avoid returns, all those things. This is a standard purchase and a payment. Okay, so let's walk through it. You want to do seller or buyer first? Buyer. All right, who's the buyer?
Bray.
Okay, yeah. So Bray is the buyer. All right, so what do they do? What type of transaction do they enter into? So they purchased merchandise. All right, so merchandise is an asset. So if they're increasing their amount of asset, we're going to debit merchandise inventory. Okay? How much are we going to debit? Would it be 11.5? Would it be 6,900? All right, so we purchased $11,500 worth of inventory, but they offered us a 2% discount, and we assume that all the discounts are taken. So what would the amount be?
11,270.
Yeah, 11,270. So that's something that you have to be careful of, because it's real easy just to look and see, hey, 11.5, well, that's the amount that we bought. Well, in theory, it is, but we were offered a 2% discount, and we took it. So we wouldn't want to record 11.5 if we actually took the discount. All right, so we received a merchandise inventory of 11,270. How did we pay for it? All right, so how would we record that? Accounts payable. So we're going to set up a liability, and that serves as a promise for us to pay Seabrook Company $11,270 at some point in the future, which we know is within 15 days. Okay? Now, the cost of merchandise sold is $6,900. Does that matter to the buyer? How much the cost associated is? No, it doesn't, because all we did, we went and bought the goods, and now all we have to do is worry about paying them back. So in 15 days, the only thing that we're going to be worried about is paying off our liability. So whenever we get ready to pay it off, we're going to debit accounts payable, because we're getting rid of this liability, we're paying it off. And how would we pay that off? With cash, right? That's the only way that the buyer is going to say that our transaction is complete. All right, so for the buyer, they go and they purchase the goods, and then 15 days later, they go and pay it off. All right, so let's look at the seller. So what all do we have to figure out for the seller? First of all, what happened for them? They made a sale, right? All right, so how would they record their sale? What would they debit? Anybody? Yeah, accounts receivable. So they purchased it, or they sold it on account. So we're going to record accounts receivable, which is an asset. So this is a promise to pay from our customer. All right, what amount would we record for that accounts receivable? Yeah, the 11, who said that? Right, the 11,270. So we sold 11.5 worth of goods, but we offered them a discount, and we know they're going to take it. All right, what would our credit be? Yes. So we recorded a sale. Okay? Are we finished with the sale of those goods? Why not? Yeah. So along with that sale, we have costs that were associated with it. And we know those costs are $6,900. So we're going to debit cost of merchandise sold, which is what type of account? An expense. So by debiting that expense, we're increasing that expense. All right, so we debit cost of merchandise sold. What would our credit entry be? Merchandise inventory. Because if we sold these goods, we no longer have them in our warehouse. So we're going to credit merchandise inventory for $6,900. All right. So now we've taken care of the sale. How do we account for Bray Company coming and paying their invoice? So if they come and pay their account receivable balance off, what does that look like? A debit to cash, and then a credit to accounts receivable. Because they no longer owe this balance. Okay?
So the 2% doesn't pertain to the cost of the merchandise sold?
No, so you would record your cost for what you actually paid for it. So the discount, like if you spent $1,000 on a shirt and you bought it to sell in your store, but you sold it you had a 50% discount, say, you still paid $1,000 for the shirt to be able to sell in your store. So you can't discount what you paid for it. The discount only applies to what you sell it for. That's a good question, though. So the cost of merchandise sold is what it is. It's not affected by any discounts that we might offer or anything like that. Okay? It's a good question. All right, so does that make sense? The buyer side is going to obviously look different than the seller because they're looking at different things. They're worried about different things. So can you guys recreate this on a test? Can you look at it from the buyer side, look at it from the seller side? I think so. All right, let's look at our homework. Because I know in the other class, some people had some questions. So,
I have a question,
all right, hit me with it whenever you
um,
get it on part 2 or part 1.
the one that was due last week.
Okay. I hate Face ID when I'm wearing a mask. All right, so let's see here. Okay. All right, which one is it?
I don't know what the number is, but it was the one that said transactions and all of the same.
Okay. What? Oh, I messed up. All right. Can't be on it on my iPad and here. Come on. Okay. I messed up by trying to pull it up on the iPad and the computer. Okay. This right here?
Yes.
Okay. All right. So this says Statham Company sold merchandise to Bloomingdale Company on account 147,600 terms FOB shipping point with credit terms, a 2% discount within 10 days. The net is due within 30. The cost of the merchandise sold is 88,600. Statham paid the freight of 2,400. Assume that all discounts are taken. All right. So a lot going on there. I wouldn't give you a question that was that involved on the test, but we can definitely work it out. Okay, so journalize Statham Company's entries for the sale, for the purchase, and for the payment of amount due. All right, so first off, I like the purple button. All right, so Statham sold merchandise to Bloomingdale on account for $147,600. All right, so that's the gross sales price. We offered a 2% discount, and we say assume that all discounts are taken. So we can either multiply that by 98%, which is how much they actually paid, or multiply by 2% and then subtract the difference. Okay? So it comes out to $144,648. All right, so that is the amount of the actual sale. All right? So if we're Bloomingdale, or if we're Statham, we are going to record accounts receivable for the $144,648. And then we're going to record a sale, just like we did in the last problem. Okay? Also, we have to account for the cost of merchandise sold. So, cost of merchandise sold would be $88,600. And then we want to get rid of $88,600 worth of inventory. Okay? Now, how do we account for freight? First of all, who maintains ownership as it's being transported? Well, so FOB shipping point means that ownership transfers to the buyer when it is actually shipped. Okay. Well, so I'll show you. So they pay for the freight, but they're passing the sale on to, or they're passing the cost on to the buyer. So we are going to, so the buyer is obviously going to pay us back. Okay? So we're going to record an additional account receivable. So it's basically just like a prepayment. So the buyer is going to end up paying the full cost, but the seller paid for it up front. Okay? So that's an increase to accounts receivable of $2,400. And then you remember, freight is always paid in cash. So that would be a credit for the seller in cash of $2,400. Does that make sense? So the buyer is actually in ownership of the goods while it's being shipped. But instead of selling it for $144,648, making the buyer send you $2,400 and then shipping it, the seller just went ahead and paid for shipping cost, but then passed that cost on to the buyer. Does that make sense? Okay. So, what is the total amount that the customer is going to pay us back? This is A. This is B. So what's the total amount that we're owed? 147,048. So how would the seller record that? The customer is paying back their account receivable balance. So we know we're going to credit accounts receivable. And the only form of payment that we would accept is cash. All right, so that's the seller side. Any questions about the seller before we talk about the buyer? Do what? All right, so we're done with the buyer. Now let's talk, or we're done with the seller. Sorry. Now let's talk about the buyer. All right, so if you're the buyer, we know that we are going to purchase $144,648 worth of goods, which is the 147.6 minus the 2% discount. We also know that the cost of the freight is ours, and that cost is ultimately getting added on to us. So we know that this is the total amount that we pay. Okay, now under FOB shipping point, we can add those shipping costs onto the total cost of our merchandise inventory. So whenever we record merchandise inventory, we get to record the total $147,048 as our merchandise inventory cost, because we were in ownership of those goods while they were being shipped. So that was a cost that we can add to our merchandise inventory. Now, how do we pay for this? On account. So we'd have to set up a liability, accounts payable. All right, then next, we would have to pay our balance off. So to do that, we would debit accounts payable, and then we would credit cash as we pay it off. Okay? You see how it's working? Anybody have any questions remaining about that? Okay. Anybody have another question about another problem? Let's look at it and see. All right, so this was another one that somebody had a question about. And this is just like what we worked a little bit earlier. So this says, determine the amount to be paid in full settlement of each of the two invoices, assuming that the credit for returns and allowances was received prior to payment. Whoops. And then all invoices were paid within the discount period. So the issue of freight all hinges on what are the freight terms. If it's FOB shipping point, we add them to the cost of the merchandise because we're retaining ownership while it's being shipped. If it's FOB destination and we don't assume ownership until it's delivered, then we can't add it to the cost of our merchandise. Okay? So in part A, we have merchandise of $58,600. We returned $6,500, and it's a 1% discount. Brain's not working too good. 58.6. 58,014. And then 6,435. All right. So the amount of merchandise we purchased with the 1% discount is 58,014. If we returned 6,500, then that's going to give us 51,579. Okay? Why did we not add freight to the cost of that merchandise? Yeah, so we didn't have ownership of it while it was being shipped. So the seller could have passed that cost on to us, but we can't add it to what we deem as the overall cost of the inventory. You can only do that when it's FOB shipping point. All right, so then let's look at B. So B says 73,100. We ended up sending back 3,900. And we had a 2% discount. So 73,1 is 71,638. And then $38.22. All right, so our net cost of the merchandise was $67,816. All right, but there's $600 of freight, and the terms were FOB shipping point. So we maintained ownership of those merchandise goods while they were being shipped. So in that case, we can add that freight to the total that we record as merchandise. And that's how we get the 68,416. Okay? Any questions about freight? So we'll have questions about it on our test. And they'll be similar to the ones that we worked today. I didn't get a chance to start chapter 16. So we'll only have one class session covering chapter 16. So the amount of material will be limited. Okay, so I won't test you on anything that we haven't covered in class. So that'll be a good thing for you in that you won't have new material. I guess the downside to that